Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary. Global equity markets have rallied strongly in 2023 to date, following through from a sharp recovery in the last quarter of 2022. The leaders this time, though, have not been US technology and growth names, but rather European industrials and banks, alongside Chinese technology and property names. Adjusted for currency, Europe has actually been the strongest performer, with a 7% return for the first 2 weeks of 2023, one of the strongest starts to a new year ever recorded. This change of tempo reflects three key events. First, better than expected inflation numbers in the US and Europe. Secondly, the extraordinary success Europe has had in diversifying energy supplies away from Russia. And third, the rapid reopening of the Chinese economy. Together, these have created something of a Goldilocks picture for the world economy, where inflation slows rapidly, but the US and Europe managed to achieve a soft landing. This combination has been rocket fuel for global equities and bonds. Central bankers, though, remain very nervous. Inflation is still a multiple of their underlying targets, and a sharp rise in equities and other risk assets only loosens financial conditions and makes their job more difficult. This suggests we will still see higher rates for longer, even if world economies slow markedly. And this in turn raises the chance of a global recession as the only means of conquering inflation. So yes, we see some extraordinary opportunities in global equities today, but there is still a very narrow macroeconomic path to tread between inflation and recession. So we need to keep an eye on the downside for just a while longer. So global equities rose an extraordinary 5% in the first 2 weeks of 2023. Why? Well, as we discussed earlier, the first reason I think is improving inflation numbers globally. I've shown here for the US, the CPI rolling quite markedly now, down to 6.5%, with the core CPI down to 5.7%. Still a long journey back to the central banker's target of 2%, but moving in the right direction. The second key factor has been the extraordinary diversification of energy supplies by Europe. Gas reservoirs now for the EU as a whole are actually 28% fuller than they were a year ago, helped of course by a relatively mild winter. The impact on energy prices has been remarkable. Look at that collapse there in German and UK natural gas prices. Germany's been particularly remarkable. Industrial and power sector demand, which accounts for 60% of German gas consumption, was actually down by 31% compared to the 3-year average before the crisis. Extraordinary achievement in terms of productivity and output. The UK, meanwhile, is at the epicentre of many of these storms. Yes, there's a glimmer of light on inflation. UK CPI reported this week down to 10.5%, a small move down from peak, and an incremental move also in the core number. The Bank of England, though, are more confident. They see UK inflation falling to 5.2% by the end of 2023 and 1.4% actually below target in 2024. But the pain is going to be intense, particularly in the labour markets. Nearly 500,000 days were lost to strike action in November and December, and that is only going to get worse. Indeed, Bloomberg feel that 450,000 workers are aiming to strike on February 1st alone. That's university staff, train drivers and civil servants. That will be equal to almost all the days lost in November and December. The third positive factor that's been supporting market is China reopening. Now, we're not wearing rose-tinted spectacles here. The path is going to be rocky in the short term for sure. Case numbers are probably being underreported. There is an extraordinarily large elderly population, almost 250 million people aged over 60, and very limited intensive care support. There are only 3.6 beds per 100,000 people in China compared to 34.7% in the US. Timing also couldn't be worse. The winter flu season and Chinese festivities are going to boost travel. Nevertheless, we expect output to recover materially, with growth in 2023 being about 5% compared to 3% this year. Yes, there'll be some spillovers. China also will want liquid LNG imports and oil imports, so that will put pressure on energy markets. But overall, a clear positive for Chinese and Asian demand. And the picture's already beginning to improve. Some of the high frequency indicators show this. I put the volume of passenger transport in Beijing on the left here in blue on the subway, rising quite nicely, and road congestion just beginning to normalise. So already Chinese demand is beginning to rebound. You can see this too in the copper price and the share price of something like Rio Tinto Zinc, which is heavily dependent on Chinese demand. So the underlying picture looks encouraging. Markets are rising strongly, corporates are relatively confident. But we're still a little bit cautious. Why? First of all, I think recession is still a real risk if central banks have to go into substantially contractionary territory to squeeze inflation out of the system. And you can see activity is beginning to slow quite rapidly. On the left is the famous US business survey, the ISM, for services and manufacturing. Both of these now below 50, indicating contraction. Meanwhile, on the right-hand panel, the difference between the 2 and the 10-year bond, the so-called Treasury curve inversion, is screaming a deep recession, now down at numbers we last saw in the early 80s. Secondly, equity valuations are not that appealing. Yes, they're round about average at about 15 times for global equities, but we're not yet cheap. You've seen that number fall below 10 in times of severe distress. On the right-hand panel, I've looked at the much longer term using the Shiller PE ratio, which is now at about 29, well above the average for 21, and far above the sort of levels we saw back in the 70s and 80s when inflation was a real problem. So wrapping this up, patience please. The numbers are encouraging, the earnings have not been nearly as troubled as we expected, and the energy picture is certainly far better than we hoped for. But still there are risks ahead. So we're running a mildly underweight position. We're still participating dramatically in these equity recoveries. We've got good numbers coming out of bonds and our alternatives are continuing to perform. But we've got an eye on the downside, a little bit more cash, portfolio insurance, and a caution on liquidity and quality across our equity selection. So patience please for just a while longer.